Good afternoon, good morning. Hugh, David, big welcome from Columbia Business School. Really appreciate all of you attending here. It's a really nice turnout. The purpose of the discussion today is to discuss the role of Fannie and Freddie, the GSEs, in the housing market just briefly at the beginning, and the current Trump administration discussions to privatize both Fannie Mae and Freddie Mac and to take them out of conservatorship where they've been since the 2008 financial crisis. So with me, I'm honored to have both Hugh Frater, the former CEO of Fannie Mae, and Dave Benson, the former president of Fannie Mae. So we've really got quite an expertise panel here. Let me just briefly read their bios to you, just so you are truly impressed. Dave Benson was president of Fannie Mae, the largest provider of mortgage credit in the United States with over $4 trillion in assets. As president, from 2018 to 2024, he was responsible for each of the profit and loss producing business units, single-family residential and multifamily, as well as several corporate functions, including finance, IT, operations, strategy, human resources, and communications. He was directly responsible for 100% of the company's revenue of $25+ billion and 90% of the company's headcount, which is 8,000. In 2022, David served as Fannie Mae's interim CEO and was a member of the company's board of directors and a member of the board's community, responsibility and sustainability committee. He served on the search committee for the permanent CEO hired in December 2022. But what I find most impressive about David, well, he has an MBA from Stanford, so he won't, criticize that. But in addition to picking up an MBA from Stanford Business School, he has an MD from Harvard Medical School. So are you actually a doctor as well? So, let's talk about fixing Fannie and Freddie. And he has a BS in psychobiology, summa cum laude, from UCLA. David resides in Jupiter, Florida, and Bethesda, Maryland. And Hugh, no slouch either, founding partner of BlackRock, and has since been the CEO of several companies, including Berkadia, a commercial real estate services firm jointly owned by Berkshire Hathaway, and Leucadia, and most recently Fannie Mae, one of the world's largest companies and a leader in residential and multifamily housing finance. He guided the company through the pandemic, providing record amounts of liquidity to the mortgage market, and was a champion of numerous innovations designed to help keep people in their homes and reduce inequity in the housing finance system. His passion for housing continues through his current work as chairman of Vessel Technologies, a New York-based startup dedicated to using innovative building techniques to produce unsubsidized workforce housing. He also serves on the board of directors of Hippo Analytics, a fintech home insurance company, Shift Capital, a neighborhood redevelopment company, and the Bipartisan Policy Center, a Washington-based think tank dedicated to finding bipartisan solutions to our nation's most pressing issues. He's a graduate of Dartmouth College and the Columbia University's Graduate School of Business, where he serves on the board of overseers, so be nice to him. Prior to graduation from Columbia, he was director of programming for the Learning Channel, an educational cable television network. With that, please give them a warm welcome. So what we're going to do today is just for a couple of minutes, because I know a lot of you are in real estate, but some of you may not be. So I asked David, we're just going to throw a few slides up to give a little bit of background on what Fannie Mae does, and Freddie Mac is sort of interchangeable. And then also what their current state is in terms of conservatorship, since we're talking about proposals to get them out of conservatorship, you first have to know what it means to be in it. So David, do you want to take it away?
Okay, well, hi everybody. So Fannie Mae's been around for 87 years. It started off as part of the federal government during the Great Depression under the Franklin Roosevelt administration to help liquefy a moribund housing market at the time. Privatized in 1968 by the Johnson administration, and then went back under an unusual government control that we'll talk a little bit about in 2008, which is the conservatorship that it currently finds itself in for the last 17 years. The mortgages are produced and where the credit risk is owned in several entities, most of which are either directly or indirectly part of the federal government. Fannie and Freddie are the two largest. That's about 55% of the market there. Banks, another 22%. Ginnie Mae, which is a full government program, which is a full federal guarantee, that's inside the government of 22%, and a very small slice currently of 4% that's in what we'll call the non-agency mortgage market. This is just Fannie Mae. If you wanted to add Freddie Mac, you could kind of, close to double these figures. So basically 1 in 4 loans are done by Fannie. It's over $4 trillion balance sheet. Freddie's close to that. Both Fannie and Freddie are two of the largest companies by assets in the Fortune 500. I think I heard you say that Fannie may be number 1, JP Morgan number 2, and Freddie number 3 of assets within the corporate structure of the U.S. And very, very profitable companies. Fannie Mae's been earning, in the 16, 17 billion range per year for a number of years now. Just to describe just very briefly, when you go and you buy a house and you get a mortgage, there is an investor in your mortgage. And in the sense of how Fannie and Freddie do things, they basically are packaging your mortgage with other mortgages into mortgage-backed securities that are then sold out to investors. The lender that you typically go to, that you're getting your loan from, doesn't usually keep that mortgage. What they've done is they've sold it on, and Fannie and Freddie are two of the major outlets that they've sold it on to. So Fannie Mae is really in that guts of the entire system of being able to liquefy the mortgage market the way it's done today. When you get your loan, and these rates are a little bit lower today than what this slide shows, but just to give you a sense, if you started off with knowing what the yield on a 10-year treasury is, the mortgage-backed security that's created that I just mentioned that Fannie or Freddie may end up producing ends up carrying an interest rate that's going to be somewhat higher than that, in part because the liquidity of the mortgage of that pool of mortgages is a little bit less than treasuries. Treasuries are the most liquid asset in the market, the largest asset class in the market. Mortgage-backed securities are second and are quite liquid, but it still carries a premium over treasuries. And then the largest part of the difference in rate is due to the prepayment risk that's involved. If you think about it, you as the mortgage holder at any given time may end up paying that off. You may refinance, you may sell your house. The investor doesn't know when you're going to do that, so he's effectively sold you an option on when you can do that. And that option has quite a bit of value, which isn't a value that you hold, but you have to pay for that option and getting that option to be able to prepay. So that's why you get that significant bump in rate. The next level that you see is really the mortgage rate you actually got from the lender, and that incorporates a few fees. It incorporates the fees the lenders have charged effectively for origination. It includes a servicing fee, which is the fee that is paid to a company that is actually dealing with the administration of your mortgage throughout time. They kind of collect your payments and kind of do the accounting on all of that. And the third thing is the guarantee fee that the GSEs will charge to guarantee those mortgage-backed securities that the investors have now bought, that the investors didn't want to worry about whether you were going to pay off your mortgage or not. They just wanted to know that they were going to get their money. They just don't know when they're going to get it because they don't know when you're going to prepay. So they're willing to take that risk. The GSEs they charge a guarantee fee for their guarantee, which makes it such that those securities are viewed as being effectively money good, just with uncertain cash flows. Just to give you a sense, the guarantee fees that are being charged by the GSEs are around 55 basis points, so about roughly 0.5%. So you've got these very successful companies in terms of what the monies that they make, but you've got now this is somewhat dated. I'll give you a date here at the end of 23. But the companies are valued in the stock market much, much less than you would actually expect since they make all of this money. Now, I will tell you that price at the time that President Trump was elected about a year ago was right around $1. And now, a year later, it's around $9 or $10. It's gone up 9 or 10 times since that time, which is very interesting. And yet the companies are still in government conservatorship. They still are making this kind of money. So what's really happened there? And a lot of that is speculation on what's to happen next. because you've obviously got these very attractive companies, but they've been trading very, very cheaply, but there's a reason for that. So we'll talk a little bit about what's entailed there. And you really have to go back and do a little bit of a history lesson on the great financial crisis to understand why we are where we are today. The housing market prior to the great financial crisis peaked out in 2007 and it started to decline. There were some very, very poor loans that had been underwritten during that period of time. You may have heard of them. These were Alt-A loans and subprime loans and the ninja loans and other loans, basically with low documentation or no documentation. People basically, a lot of them were called liar's loans, where people basically made up what their income was and so forth. In any case, housing markets started to go down. A lot of those mortgages actually went down as well. And what the government decided to do in September of 2008 is to put both Fannie and Freddie in a conservatorship and to backstop those companies because they were concerned that the companies would lose so much money that they would basically go out of business. It would destroy the housing finance system and the mortgage market. So the government basically came in and effectively bailed them out. They actually had thought at the time that by doing that they were going to stop the bleeding, so to speak, in the economy and what was happening in the financial system. But it didn't take long. It was only 1 week later that Lehman Brothers was taken down. And then we know the rest of the story, where the federal government ended up having to bail out several of the banks and putting capital infusions in various banks and all of that. So I'm sure you've read the history of that. For something that's also just interesting to note is the home prices ended up bottoming in August of 2011. So it was about a 4.5-year period of time of, from peak to trough of what you saw happen in the housing system. And it wasn't until really 2012 that you started to see the GSEs start earning profits again. So this conservatorship that was created in September of 2008 had a number of different aspects to it. First of all, and most importantly, the government put in place an agreement with them to backstop the capital of the GSEs to a very great degree. And it was many tens of billions of dollars. But in doing so, they said, look, we are going to put a conservatorship in place where the government has control of the management, the boards, and everything that happens in the companies. We're going to call the shots, we're going to control things, but you're going to kind of do basically what we need you to do. So the government backstopped it. It also took a majority stake in the equity of the companies. It was a 79.9% warrant on the common stock. We were asked why not 80% or a higher number, and the reason was at the time it was believed that if they went to 80% or more, that they would have to consolidate the balance sheets of the GSEs onto the federal balance sheet. And so at the time, the GSEs were about $6 trillion. So you would have had $6 trillion more of debt that would have been placed on the federal balance sheet. So they didn't like the look of that, so they decided to kind of do it in this way. They also had an interest payment that was on the monies that were borrowed by the GSEs in the form of a preferred stock of 10%. That actually, 4 years later, they amended it not to be 10%, but they said, you know what we're going to do is, instead of 10%, we're just going to take all of your earnings. So 100% of your earnings. So even if you don't make the 10%, we'll just take that. But if you make more than 10%, we're going to take all of that too. That became a very controversial thing, you can imagine, for people who still had shares in the company. It's been litigated. It went to the Supreme Court. The government won. But it was a very interesting part of the story. For whatever it's worth, the amount of money that Fannie Mae took from the government was about $120 billion, and they paid back about $180 billion. So the government has gotten more than it took back. It earned a rate of return that exceeded the 10% that they were actually after. But having said that, they still carry the preferred stock on ownership as well as the equity ownership, which they'll have to kind of work through if they decide to privatize the companies. Also very important to note, the companies, to the extent that they wanted to raise capital or if they wanted to pay off the government, are not permitted to. Only the government, if the government allows them to, they can, but they're not of their own devices permitted to do that. That would be something the government would have to agree to allow them to do. So for all intents and purposes, the government really controls what goes on to that extent. Let's see if I go back. This just gives you a little bit of a chart of kind of the way that the earnings pattern looked for Fannie Mae prior to the financial crisis. Profitable company, but the most profitable year was in 2003. It was $8 billion, and the company makes, double that now. So something has gone right in conservatorship, if you want to call it that. Key things being that the guarantee fees, I mentioned that they charge 50, about 0.5%. Were less than half that prior to the crisis. They were maybe more like 20 basis points. The other thing that's happened, so they charge more, but also the market itself has grown quite a bit. Most of the profits that Fannie Mae made were from investing in their own securities. This was before the crisis. They don't do that much at all. That's really very, very little of that is done at this point. All of their money is being made by the guarantees, and that market's grown. The market share of Fannie and Freddie has grown substantially since the time before the crisis, and in part that happened because all other sources of mortgage credit kind of stepped away during the financial crisis itself, and Fannie and Freddie were the only game in town. The government backstopped them. They were the only game in town. So it's been a very consistent pattern of profitability really since the years of the financial crisis. So I think we're going to spend some time talking a little bit about kind of what's next and what might happen, with this conservatorship and whether it ends. So
That was great.
I'll throw it back to you, Brian.
Thank you, Dave. So just one other thing I forgot to mention, that please make this interactive. If you want to ask questions while we're having the discussion, just raise your hand. We want to make it more like a classroom than a formal presentation. Just makes it more interesting, I think, for everybody. So that was a great summary of where Fannie and Freddie were, where they are now. So let's talk about the Trump administration and what they're talking about. So first, is the ideas coming out of DC, are they for full privatization, a partial public ownership, or some sort of a hybrid model? What are you hearing in terms of what's being suggested?
Well, I think there are two things that you've been hearing about or reading about. One would be the big, beautiful offering. They've thrown a number of $30 billion out there. The $30 billion is a significant figure because it's bigger than $28 billion. The reason $28 billion is significant is that was the size of the Saudi Aramco IPO, and so obviously this administration, being who they are, the 30 is more than 28, so that's why 30. But what they have talked about is doing an offering while remaining in conservatorship under government control. That is very different from another process which is also going on, which is the process of the Treasury meeting with different stakeholders, thinking about all of the different steps that would need to be taken to fully reprivatize these companies. And that effort continues. That will take a certain amount of time. The steps are pretty well understood. There are political and other judgments that would need to be made along the way, but that process, done in a deliberate fashion, would probably take a year or two or something like that. And all the while, to some of the numbers Dave was citing earlier, these companies would continue to recapitalize. So they'd probably be at or near their minimum capital levels, regulatory capital levels, within 12 to 18 months, just by the normal course of business. And in that period of time, the Treasury and other stakeholders could take the steps they need to fully reprivatize them. The offering you hear about, whether it's through tweet or other media, is really an idea that is not a recapitalization. It's not even sure what to call it, but it would, if it can get done, it would be probably a highly structured security that would be invested in by people that want to show support for the administration. It's possible. I've heard people talk about actually investors being offered buyback rights to the extent that a full privatization doesn't happen. So if you hear about a big, beautiful offering that happens sooner rather than later, it's not really a capital raise. It's more I'm not sure what the polite way to say it would be, but anyway, it's not really a capital raise. The full reprivatization and capital raise and reprivatization would take a couple of years. But the steps are the steps are well understood, and the effort is in the early stages of being underway.
Mhm. Dave, I mean, so the $30 billion would be, would that be, would that be,
There's a whole bunch of
I mean, it would still be in government control,
It's
but you would
it's
sell.
still in government control. So if you think about it, I mean, there are corollaries in the market. People have invested in capital raises in banks that were subject to a consent decree.
Mhm.
People have done that. So there are precedents for this. But as Dave was saying, conservatorship, in conservatorship, you're in complete government control.
Which is the state right now.
If somebody said, "I'd like you to invest in the Department of Agriculture," would you? So I think you wouldn't. The answer is you wouldn't without a clear understanding of what you're going to get back.
Right.
And so this is not that different from that. But it would be, and I'm not sure, Dave and I think it's fair to say we both think it'd be a stretch to get 30 billion. But if you went to some friendly sovereign wealth funds and said, "Look, we need you to put we want you to invest in a convert with a big strike price that values these enterprises at it's a very substantial figure, so it makes for a great headline." That's the kind of thing that might happen, and the question is would that truly be? It would not count as regulatory capital. It wouldn't be. Would it truly be risk bearing? Certainly wouldn't be if there are buyback rights and things like that. So I think that. And by the way, if they can get it done, more power to them. But I just don't think sane fiduciary investors would invest in some of the things that have been talked about.
Yeah, but I think that if a regular way recapitalization was done on the balance sheets of the GSEs to accrue, to get them out of conservatorship, I think we agree that 30 billion is very doable.
Oh yeah, once if it's
the real deal,
regular way recapitalization, absolutely. It's just that the thing that you've heard about being done before the end of the year, that's not a real capital raise.
Right. So, I mean, there's no discussion as part of that capital raise, the government changing the status and giving up control of them?
Yeah.
What I've heard, just at least what they seem to be saying is if they do this kind of quick transaction that they've been talking about, the conservatorship itself is not affected by that because it doesn't really change the capital worthiness of the companies because the capital, this is more of a sale of interest that the government is making to others, but they haven't really changed the dynamic of the actual balance sheets of the GSE, so the conservatorship remains intact.
And could that be done? That could be done without any congressional involvement. That could just be done. I guess the two actors here are Pulte, the FHA,
Secretary
and Scott
Besson.
Besson.
Yeah,
Correct.
and I think, and maybe this is where you're headed, but I think that for a long time the hope had been that Congress would act into conservatorships. The investor community had hoped that there would be a formal full faith and credit guarantee, a la what Ginnie Mae has. I don't think there's anybody that thinks Congress is going to do anything, and so much of the emphasis, all of the emphasis, has been on administrative paths to exit.
Are there any other things that the administration could do besides this offering? It sounds like this would be something that they could do. And sort of what is the you sort of glossed over the purpose of this. Is this marketing or what would the purpose of this be?
Well,
I mean, we were talking a little bit before. $30 billion is a drop in the bucket. Like, I mean, it's real money, but
no, I think if you means tested Social Security, you get a lot more bang for your buck. I mean, this is not going to change the federal income statement or balance sheet very much. And there's actually, not to get too far into the weeds, the way the government actually accounts for the interests in the enterprises, it would really be just a moving things around on the left-hand side of the balance sheet. You'd take something that has a value on the balance sheet and you'd turn it into cash, but you wouldn't actually increase. You wouldn't actually.
Yeah, that's a great point. The way that the government accounting works is that the earnings of the GSEs are I think already assumed in their math. So if they're seeing 30 billion a year coming in that way, that's what they have. If they go and they sold their interest, what would happen is they'll no longer have the 30 billion a year coming in that they were assuming for a 10-year period, but they will liquefy it on a present value basis. So I'm not sure, in that trade, it would be kind of a de minimis difference in terms of the government accounting.
And could you talk a little about the private stakeholders currently in Fannie Mae, and would this offering impact them at all, or is it totally separate? We talking like the Bill Ackman.
Yeah, well, I think, Bill, I mean, I think Pershing and I'm not sure how much it is owned in which investment entities, but I think Ackman's doing a podcast or something tomorrow on a sort of new recapitalization plan. And his team has written some really good, really comprehensive stuff on all of this. From what I understand, his company still owns the common stock. And then there are other companies. I think John Paulson's company is one, owns the junior preferred stock. And there are a couple different tranches of junior preferred, which have different different terms. And again, this is part of the would be part of the sausage making and a different conservatorship. What happens to the existing common holders? What happens to the junior preferred holders? And there's a variety of different ideas out there on how to handle it.
Yeah. It's interesting because we took note that a year ago, Fannie stock traded about $1, and now it trades around $9 or $10. And so, and all of this is speculation on what will this, if there is a transaction.
This
will it
$30
happen?
billion transaction, or?
Yeah, well, yeah, what is the transaction? When is the transaction? And what would it mean to the current equity holders? And what value will the equity holders actually have at the end of all that? Because it's unclear what, in what way, to the extent the government is doing something here, are they going to, what will they do with the existing positions that they have in senior preferred stock? And are they going to, are they going to want, more equity for that? Or are they going to write it off? Or what's the deal going to be that the government is going to put on the table that will largely determine, if they were to do this in a privatization, what the current equity holders' actual value will end up being? How much dilution will they end up having, if any? And so that's what, there's a lot of volatility in the stock, and it's not because Fannie's earnings or Freddie's earnings are changing that much. They're all pretty stable. It's because of the speculation on sort of what this deal might look like if it were to occur.
And the range of outcomes, and Dave was alluding to this earlier, the range of outcomes that you hear people talking about is taking their senior preferred position and converting 100% of it to common equity, which obviously results in massive dilution, and the other is complete forgiveness because it's been repaid with interest.
Right.
And so those are the goalposts, and a whole array of things in between. And on the for completely forgive it, and people would say, well, that's just a gift to evil hedge funds. And on the other end of the spectrum, it would be litigated and viewed as another taking by the government of value that's held in the private sector. So that's where the sausage making comes in.
Right. We were talking before about privatization, the whole idea of just bringing this topic up. And could you talk a little bit about sort of what we talked in class a little bit about what sort of is not being discussed? And so it's interesting. I mean, it's one level. It almost sounds like you're being a bit dismissive. That this is just as though a $30 billion, marketing attempt to, sort of get into the news. But I mean, there are real issues. I mean, people really believe that Fannie and Freddie should be privatized and all the benefits that, privatized utility, the utility phone companies and all that stuff. But,
yeah, it is kind of curious.
Why isn't anyone talking? Go ahead.
Yeah, it's curious because most of what we've heard about is, well, the government's got this very valuable stake, and so how is it going to monetize it? And so that seems to be the focuses of, wouldn't it be great if the government could monetize the value? Okay, that's fine. But what I find even fascinating is there's not a lot of discussion that at least that you read about, well, what problem are we trying to solve? Is it just about a financial transaction, or are there policy considerations about in housing that are important here that the government has an interest in, and whether, what rights does the government, expect to have and want to have, and how are they wanting to shape the future of housing? Are these companies, as private companies, going to be more effective or less effective in terms of how the government would see, the future of housing going? If you can imagine, as private companies, these companies would have shareholders to be able to deal with. They're going to have return characteristics that are going to be kind of formed on the basis of the market principles. Whereas now the government really controls these entities, lock, stock, and barrel, and can define whatever they wish those outcomes to be. They don't really have to have a discussion with shareholders about what they intend. And yet that discussion doesn't seem to be there. I think the closest we come to it is this idea that, well, if they were privatized, will mortgage rates go up? Like that's about the only thing I've kind of heard out there that's a little bit of a policy issue that, and it's been said, I think by the Secretary of Treasury said, look, we wouldn't want to do anything that was going to disrupt the mortgage market and wouldn't want to disrupt more. So that's one, stake that's been put out there. But are there any other things that they care about? Is it an ideological philosophy that, look, these entities were effectively nationalized, but as you like to say, we didn't tell anybody, we didn't ask anybody, it just kind of happened. And if you're going to go do that, shouldn't there be a process, or you just they're intended to be private sector entities, as most of the economy is, as other industries are. And if that's the ideological position, then that's fine. So it's an ideological one. But then, what are the other things that the government may want to care about? We talk about affordability. Are there issues around affordability that the GSEs are supposed to be working on that would be better served in government or better served by the private sector or what have you? So it's just, I find it fascinating that there's not a lot of discussion. Yeah, I would guess that will come because it's just more sexy to talk about the financial transaction, I guess.
Right.
But there's still a policy discussion to come, I would guess.
Right. Do you think they should be privatized? I mean, we talked a little bit about that before. They've been doing pretty well, but do you think there's a benefit to it? I mean, we privatized the phone, create more competition, all that good stuff. Should there be other companies to compete with them?
It's the right question to ask. And as Dave was just saying, what problem are we trying to solve? And is there more risk than there is upside? And or
are we just fine as the way we are?
Maybe this is an ideological view on my part, but I just think the more government engagement that you have in enterprises that could be private, the worse off you are over time. And it's certainly, at a minimum, it chills innovation, and it also results in diminution of human capital. We've seen that happening, and I think that the main reason to have them out of conservatorship is because they shouldn't be in conservatorship, and I think that the benefits, unfortunately, are somewhat intangible and on the come. Would they be more innovative companies? Absolutely. Could they come up with creative ways to reduce the non-mortgage costs of acquiring a home? Yes. Could they do more to have variable risk pricing so they could actually, on balance, lower the cost of mortgages? Yes, I think that potential exists as well. The concern that mortgage rates would go up is an important thing to consider. But if you think about what Dave was saying before about the main risks that our investors are taking when they buy a mortgage-backed security, they're taking liquidity risk and they're taking prepayment risk. So the question you have to ask is, well, does exiting from conservatorship and reprivatizing them and bringing in more private capital into the companies and private risk management disciplines, et cetera, would that increase or decrease the liquidity of the mortgage-backed securities market? I would say it probably doesn't decrease the liquidity. And does exiting conservatorship change the prepayment function? Absolutely not. So why would mortgage spreads change? And so I think that there's not a lot of downside. The upside, I'd be the first to admit, is ideological purity. And you think about that pie chart that Dave was showing you before. 4% of the market was private, was fully private. My friends in the banking system say, "Well, we're private too." I said, "No, you're not. If you were actually private, you wouldn't have to get bailed out every 10 years."
Right. It's the difference between J.P. Morgan and Fannie Mae.
That's right.
But if you before the great financial crisis, the share of the market that was private was probably close to 50%.
Yeah.
And so the private sector made a mess, and now here we are, 17 years later, and we've completely nationalized the housing finance system, and we didn't tell anyone. And I think that some of the things we did when we were together at Fannie were things like, should taxpayers be subsidizing vacation homeowners? No. Why? You know, and as a simple example, so we changed the pricing, and sure enough, the private sector came in and took over some of that risk. So I think the bigger policy question about why do we subsidize home ownership so heavily? What do we get for it? In the last 40 or 50 years, you know, the nominal value of homes has gone up by 8 times, let's say. The nominal value of mortgage debt's gone up by 20 times. So we've just created more debt. We haven't really accomplished anything. So, you know, I think these companies with private owners that are ruthlessly focused on earning the right return on capital and making their stocks trade above book would be a good thing, not a bad thing.
Yeah, can I just add, Hugh and I were both there together. We were managing a business. It was business people managing a business. It's a corporate culture. It's not an official government agency. It never has been run that way. And a conservatorship, by the way, I'm guessing most of you guys have not heard of any conservatorships other than the Britney Spears conservatorship.
She got out of conservatorship.
And she got out of conservatorship. There was a Poly Market, I think, had a whole thing. Is it Fannie or is it going to be Britney? And Britney got out first. I think. But so it's kind of a weird thing. This has been going on for 17 years, and I would say it's largely been very, very successful, but no one ever had thought of it as being something that would go on this long. It's intended to be a temporary thing, and it was either going to lead to these entities either being, wound up in some way or part of the government, or they were going to be privatized, but not that they were going to be in a perpetual conservatorship. So I would sort of kind of argue somebody should make the decision. I mean, either fully nationalize them, which, by the way, I don't personally think would be the best thing for the market. But again, that could be a choice, or to privatize and to get that done in the right way, and make sure that the right safety and soundness conditions and the right regulatory framework and all the good things that we know and have learned over time are put into place.
Yeah. If they were privatized, then what about the social good functions they do in terms of, high LTV, sort of minority ownership, things like that, and housing? Or could that be transferred, say, to the FHA, Ginnie Mae, or as part of a privatization?
I think we've talked about a little bit in the last session. Some of the things like duty to serve and housing goals are statutory.
Right.
And so unless the statute changes, those things will still exist.
Right.
I personally think that it would actually make sense if you think about who's providing financing to first-time home buyers. 83% of their originations are of FHA's originations. Ginnie is first-time home buyers. They're providing that important function already. The 20% or so that Fannie and Freddie do to first-time home buyers is largely competing with FHA and Ginnie to provide the same capital. So effectively competing to give our money away. I think the changes in the footprint would actually make some sense. But having said that, there's still going to be there'll still be statutory requirements. There'll still be oversight. What you didn't have before the great financial crisis, before they went into conservatorship, they were underregulated by a very weak regulator. They were dramatically undercapitalized. They were dramatically underpriced for the risk they were taking. And Dave was talking about low documentation and NINJA loans. NINJA stands for no income, no job. There's nobody in this room who would lend money to somebody that had no income, no job, unless you had to or were related to them. So I think that they're completely different, and they could be very successful as private enterprises. The bigger policy question, should they be subsidized at all, is an important one. People talk a lot about the implicit guarantee. Dave correctly says, what does that even mean? Either it's guaranteed or it's not. But I think that there is a sense in the mortgage-backed securities market, who basically pays for everything. It's the MBS investors who fund everything. They have gotten comfortable with the idea that these are enterprises that will be supported in times of need. I just think that putting another layer of private risk-bearing capital between whatever that event might be and the taxpayers is a good idea.
So in terms of the risk right now, given the Connecticut Avenue securities and the amounts of money they're making, I mean, is there really significant government risk at this point? I mean, it's always hard to say. You have a 3 standard deviation move, but the argument is if you privatize them, the government's going to bail them out. But is that really a significant risk?
You know,
You showed the
there's
billions of dollars they're generating.
but there's a really interesting disclosure that is put out by Fannie and Freddie, and they do annually. They do it's a regulatory stress test where they simulate a very dire economic condition, and they run their books through that, and they basically spit out and say, here's how much money we would lose under that scenario. So in the most recent one was put out a couple of months ago. Fannie Mae, and let me give you a sense of what that economic scenario they put it through. Residential home prices go down 33%. Commercial real estate goes down 30%. Unemployment goes up to 10%. GDP declines by 8%. And this all happens over a 9-quarter period. That's the scenario. Sounds pretty dire, right? That's actually worse than what happened in the Great Financial Crisis. So I want you in your mind, knowing that Fannie Mae's got a $4 trillion balance sheet, I want you to think to yourself, how much money does Fannie Mae lose in that scenario? I want you to put a number in your head, because I'm going to tell you the answer. We'll see how close you get. Okay, you ready? They make $4.3 billion. They run their book through that, and now, of course, think about this. They were making $17 billion a year, so they're not going to make that's all gone away. But they net they made $4 billion over a 9-quarter period, given that scenario. So you asked, how much risk is there? And by the way, that's a disclosure that the regulator approves in the whole bit. So it's not like they just do it and they just kind of say it. So you tell me. And by the way, that result has been replicated the last kind of few years. Like, that's not a one-year thing. That's been kind of plus or minus that way the last few years.
How are they making it? That's from the G fees, or where is that?
Yeah, well, it's because their revenue streams are so significant.
Oh.
Fannie Mae's revenues are close to $30 billion a year.
Right.
So if their net income is $4 billion over a 9-quarter period, that's not very good off of a $30 billion revenue base. So they were taking enormous credit losses, but they aren't dipping into their capital. So that's, they're supposed to, if they were capital compliant, they'd have about $190 billion of capital. And over a 9-quarter period, guess how much of that they would have used? Zero.
Yeah, these are
in that scenario. Now, I don't know if I believe it. I'm just letting you know that's the disclosure, but that's pretty. Now, I'm sure if you had looked before the Great Financial Crisis, given how much what they had going, it was a completely different story.
They had 45 basis points of capital, right, nominally, and
against
the level of capital that they would have on an exit on completely different underwriting standards. They would have 10 times the capital on less than half, on probably half the risk.
Yeah.
And so it'd be dramatically overcapitalized, actually.
We were talking a little bit before about obviously affordable housing, the 50-year mortgage. I'd love to get your thoughts on that. And then also, I mean, Fannie Mae and Freddie Mac, we see this also, at least the argument is with tuition, right? The more the government subsidizes demand, then the more prices go up, right? So Fannie and Freddie, is it part of the problem of high house prices? Should we be doing something else, like maybe working on the supply side?
During that couldn't agree more on that. But during the depths of the pandemic, I think we put something like 1.4 trillion into the housing market, largely in refinances. And Dave's background as a physician was very helpful, because there were moments when I was sort of feeling potential cardiac events coming on. And I knew he would be there to resuscitate me. But one of the most interesting things that was said during that time was said by a really, really smart young man who ran single-family capital markets. We were just flooding the market. The Fed was, putting their foot on the gas. We were flooding the market with liquidity, doing what we thought was the right thing to keep people in their homes and actually help the economy. A lot of that money went into renovations and things like that. But he comes into Dave's office and he said, "Congratulations, you've made it impossible for me to ever afford a house." And the reality is that, and when we were coming up with the stress test, I said to our chief economist, I said, you've got to, in our analysis, you've got to put in a scenario where home prices go down by, 10%. He said, that's not going to happen. So no, I want to see the scenario. He said, well, okay, my base case scenario is that this is for 2020, I guess, home prices would be up 6-7%. He was right. I was wrong. But the point being that the massive amount of liquidity that we put into the system locked people into 3% mortgages. Everybody's parents, or many people's parents here may have a 3% mortgage. And without changing the supply side, just introducing massive demand side stimulus, it has the effect that it's supposed to have. Prices go up. Mm-hmm. And the cost, home prices in the last 4 or 5 years are probably up, depending on where you are, 40, 50% in some cases. The cost of owning a home, now that you see mortgage rates going up, you see insurance going up, you see property taxes going up, you see repairs and maintenance going up, it's probably up 70, 80%. So we've just created a massive problem, and unfortunately these enterprises with all good intention were part of the problem.
Yeah. No, I mean, I guess there's nothing in their charter that they could, like on Ginnie Mae actually does have construction loans for certain types of housing. There's nothing in, I guess, Fannie. I mean, it also would be politically unpalatable, but as you said, sort of like tuition, what people argue, the government keeps driving more demand by subsidizing loans and things like that, and then you just keep getting price. The real issue in housing affordability is supply, and how do you deal with that, in the current environment politically? Like, subsidize the big, ugly, profitable developer.
It's a super interesting topic and a super complicated one, and there's no easy fix. I mean, I give the administration credit for trying to, in a lot of different parts, they're trying to think about how to help this problem. The 50-year mortgage is an idea that's been around for a while, but again, if it actually created a significantly lower payment than the 30-year, you're making the problem worse, not better. Portable and assumable mortgages, which are different ideas, but are worth studying. They might make a difference over time. They're not going to change anything today. The fundamental issues really relate to state and local zoning and permitting issues as much as anything else. The home builders will complain about skilled labor shortages. Probably the single most telling thing is that if you look at some of the information the home builders put out in the last 20 or 30 years, the percentage of white-collar workers employed by the home building industry has gone up by probably 300%. All of it to deal with regulation. And so, the question is, what can the federal government do about that? Well, there is one, there are probably many examples, but the one that always sticks in my head is how the drinking age went from 18 to 21. There were probably 18 or 19 states that said, we don't want the federal government involved. We want it. And Mothers Against Drunk Driving was the grassroots organization that really got it going. There are about 18 or 19 states that said, we're not going to change our drinking age from 18 to 21. And the federal government at the time said, that's fascinating. No problem. But if you don't, you're not going to get any highway trust fund money. And within a year, every state had gone from 18 to 21. So that's the kind of thing, if the government really wants to tackle housing supply issues, they need like a Manhattan Project for housing, and they need to get serious and they need to get nasty.
Yeah, I think we need to remember during the post-financial crisis period, they stopped building homes. And that's kind of what I think is almost the genesis of some of the problem that we're seeing here, because it's been estimated that we're short 4 or 5 million homes that didn't get built during that decade. And then obviously the economy continued to grow and the household formation continued to grow, but we just didn't build. So that's the issue. It's not the availability of mortgage credit between FHA, the GSEs, the other. It's the availability is there. And trying to goose that just continues to, you're pushing on a string.
I mean, some of the affordability problems, the fact that for some people, housing has never been more affordable. If I'm sitting on a 2.5% mortgage, it's probably the least I've ever paid for my house, which which are not moving.
And you're not going anywhere.
Right. We have just a couple of minutes left. Any audience questions? Yes.
Hi, thanks for talking to us. Going back a little earlier into the conversation, you were talking about the agency MBS market and maybe perceptions of credit risk if a privatization were to happen. Is your idea that the implicit guarantee kind of isn't really doing anything right now because Fannie Mae itself doesn't have any perceived credit risk, and so there would be no higher yield demanded? Or do you think there would be sort of any change in the perceived risk from investors?
Uh, you know, Dave and I both have, I think, similar views on this. You know, the worth of the implicit guarantee has been proven multiple times now, and I guess there was another. This is one where I was going to call. I was about to call Dave because I feared I might have a cardiac event. A treasurer came into this is in April of during the pandemic.
Yeah.
Our treasurer walked in and said, "Oh, by the way, we can't issue liabilities longer than a year." And then I recovered. But it has been proven again and again that the housing market will be supported by the government. And the whole inception of Fannie and the chartering of Fannie in 1938 was in response to the fact that in the Great Depression, a third of the banks disappeared. Mortgagees at that point had 3- and 5-year bullet loans. There was no way to refinance them, so 10% of all the houses in the United States were foreclosed on. That's why they created the secondary market. And what was proven, even though the picture that Dave showed you before of the great financial crisis was scary, the playbook was there and the secondary market existed, and mortgage credit never actually stopped flowing. There were 10% of the homes were foreclosed on again during the great financial crisis, but the speed of recovery and the landing was soft. And so when people say, do you think the implicit guarantee will be real? I remind people that we bailed out Carnival Cruise Lines during the pandemic. We bailed out the airlines. We bailed out the auto companies. Who else did we bail out? All sorts of people. And then other very recent examples. I mean, so I think, I think there probably will be some kind of a deal where there's some form of the preferred stock purchase agreement, which was put in place to support them, will stay in place in some way and provide some level of additional capital effectively and backstop. But I don't think there's a need for an explicit guarantee. It's never, one of the my old partner Larry Fink, when his team would come in and say, we need GSE reform, we need there to be a full faith and credit guarantee. He would always say the same thing, which is, you never had one. Why do you need one now?
Mm-hmm. Yeah, it's a great question, though, because it gets debated. I mean, there are a lot of investors in mortgage-backed securities who will argue we need to have an explicit guarantee. They make that argument. I think you and I just go back through time and we look and we'd say, we think that over time people see through, especially if they repurpose the preferred stock purchase agreements into capital support for the GSEs, which, by the way, I think they need, that would be necessary, I think, to keep the market somewhat in the same position it's in today. If they did away with that and didn't have an explicit guarantee, I'm not quite sure. I think it'd be a little bit iffy for a while anyway.
Yep. Other questions? There's another question in the back.
Hi. What exactly is the role of the FHFA director in any potential recap and release transaction? And that role has seemingly evolved considerably since Andrew Thompson. I'm curious, does Pulte's impact really matter to the companies at all, or any transaction, or is a lot of it just noise? Thanks.
Very consequentially important person in this whole ecosystem. He is whoever the FHFA director is the conservator for the company, so he carries the powers of the boards and management team. And any agreement that would be struck to have the companies come out of conservatorship would have to be a decision of FHFA itself. So the Treasury Department is the owner of the equity and the warrant and so forth, and has various there's various covenants as part of the preferred stock agreement that the Treasury carries in terms of any transaction that would occur in terms of capital and that sort of thing. But assuming that the Treasury wanted to do something, they would need to actually work with FHFA, and the FHFA would end up having to sign an agreement with them that would actually because the Treasury can't take the companies out of conservatorship. It's only FHFA that can do that.
The last amendment to the preferred stock purchase agreement, I think, put back in place the idea that Treasury had to consent to a release because they're the owner. That kind of makes sense. But
But they couldn't
FHFA is-
but they wouldn't be able to unilaterally do it. They'd
Right.
have to have the FHFA.
Right, they have to have the FHFA.
So the
Critical-
answer is very,
critical
very
pla-
important,
Critical players.
critical.
Great. Anyone else? Good. All right. Well, thank you so much, Hugh and David.
Thank you.